We need to talk about a serious potential issue in the United States and potentially global economy, and this isn't exactly bullish either. It has to do with a global credit bubble. And I know oftentimes when people say the word bubble, there are some people who are like, yeah, finally! And then there are others who are like, oh, eye roller, okay, bubble, here we go, everything's a bubble. Well, let's understand a potential scenario we could actually be facing using data that just came out minutes ago. As usual, I love presenting data as it just comes out. This data was released minutes ago here on August 7th, and this is the Federal Reserve statistical release for consumer credit. It's a little bit backward looking. These numbers are from June, so it does take them about 6 weeks to put these numbers together, or as some like to say, rig the numbers, but that usually just depends on what side of the fence post you're on. Anyway, what we found in this data was that consumer credit expanded substantially more rapidly than we actually expected it to. And this leads to some potential bubble concerns. Let's quickly understand this. So expectations were that we would see a $13.5 billion increase in credit. The previous increase in credit was 7.24, more in line with trending towards zero and potentially recessionary. Instead, we actually got another blowout number at 17.84. And while it's nowhere near the levels that we had seen at the end of last year, where consumer credit was exploding to the tune of $34 to $37 billion in a month, it's clearly coming in hotter than expected. Now, personally, I think it's important to put everything into context, and these numbers are clearly smaller than those 30 billion gains we had for consumer credit last, say, March, and really in the middle of last year where we were really exploding with consumer credit. This is really where people were getting concerned about a consumer credit explosion. And this softening has actually come as a way to say, okay, well, on one hand, that's good, less bubble risk, but on the other hand, does that mean we're trending towards a recession? And as you can see, the trend here is clearly down. This latest beat over expectations, though, sets up an idea that perhaps as we end up getting the July and August data, we could start revisiting some of the numbers that we saw in early 2022. One of the reasons we might actually see an explosion of consumer credit is what I call a weakening of loan standards. Now, this is really counterintuitive because remember during the banking crisis, what was everybody screaming during the banking crisis? Roll with me on this and you might see something here that's kind of shocking. So during the banking crisis, everybody was worried about credit contraction, but the credit contraction we actually got was just trend contraction. We were trending towards, we might go into recession, right? We might have recession, so let's plan for that. Let's do less risky lending, and companies kind of focused inward on, might have recession. Well, now, because more of the economy is anticipating a soft landing and no recession, guess what you actually tend to have? A trend reversal. And this would be looser credit standards. Now, this is forward-looking, okay? This is my opinion right here. We see consumer credits coming in stronger. We don't yet know that credit standards are loosening, but why do I think that credit standards might begin to loosen? And how could that lead to a debt bubble? Well, here's exactly how, and then we'll talk about what it means for recession. I believe that when you have companies like PayPal who are able to take their buy now, pay later loans and offload them in Europe to this company called KKR, what you're really saying is the market has an appetite for high yields. This makes sense. If risk-free treasuries are giving you 4 to 5%, and you could potentially get 11 to 15% on a bundle of BNPL loans, even if 10% of them default, you're still probably yielding somewhere between, rough math here, 9 to 13-ish% on your BNPL portfolio, which is still like twice as good as treasuries. So give me more BNPLs. But what happens? In a non-recessionary time, demand for these portfolios, demand for these goes up. In recessionary time, demand for these goes down. Okay, so now you have to think about this as a supply and demand issue. So consider this. If BNPL supply gets eaten up, what do companies like Affirm and SoFi and PayPal and credit card companies want to do? What do they want to do? They want to increase supply. They want more of these high-yield BNPL loans that they could sell off to these other pension funds or investment funds. How do you do that? Well, you do that by loosening credit standards. Basically saying, hey, look, we all thought we were going in a recession, but you know what? Good news, we're not going into a recession. Come one, come all, get your new BNPL loan. We are more than happy to give you the best rates ever, best terms ever. Come get more loans from us. Because the more loans Affirm, SoFi, PayPal, and the credit card companies can make, the more payments get processed, which is how all of these companies make money in part. Then they take the loans and sell the loans, which is another way all these finance companies make money. And then those institutions, they're the ones holding the bag. And the bag's either going to do very well and they're going to get their yield, or they'll have some defaults, or you go into recession, you really end up holding the bag. So this is like a remarkable flip, okay? Everybody's been concerned about credit tightening. I actually think now that we're trending towards a soft landing, we're likely to go into credit loosening. Now, what is that actually and practically going to do for the economy in the short term and then a recession in the longer term? Well, in my opinion, here's what happens. And obviously I don't have a crystal ball, but my expectation is if you have credit contraction going throughout 2022 and then you get a reversal in 2023, what you actually end up getting is no recession in 2023. You actually end up getting more spending and more indebtedness eventually from consumers. Eventually, those consumers will not be able to support their household payments anymore, and then you get default, and that's where you actually get a real recession. So if we're potentially right here in 2023, then this X date, I do not believe, that's your default date, right? I do not believe that X date actually occurs until sometime long in the future. Like, I don't think it's 2024. Maybe is it 2025? Probably not. It's probably more like a 26 to 30 instance, which means you can really kick the can of the recession down the road. And this is something that bears are not, in my opinion, paying attention to right now. This is not me being permeable. This is actually long-term bad. This is going to be a real risk in our lifetimes that we have to pay attention to. That people are going to take on too much debt, and there's going to be a debt bubble and a terrible collapse, and increase of bankruptcies across the board, personal bankruptcies, business bankruptcies, everything. But the problem is right now, household debt service payments as a percentage of disposable income is actually very low. Let's pull it up. Let's get the latest data right here. Household debt service payments as a percentage of disposable income, we're super low right now. You know, I know household debt itself, like nominally, is high, but people still have the income to support these payments. As of Q1 of 2023, people are spending just 9.6% of their income, their disposable income, on debts. I think we're going to end up getting back to 13 and then exceeding that level that we saw before the Great Recession. This is how you actually really create a bubble. You fuel it now with loosening credit standards. Then you get to say 13 to 20% credit or payments as a percentage of your disposable income towards credit, towards debt, right? And then guess what you end up getting? You get a real bubble. That's when you have the real collapse. So what does this credit figuring mean in the short term? Well, let's make a conclusion out of this and let's try to summarize this all together. And keep in mind, these are the sort of perspectives that I like to talk about regularly in my course member live streams daily. It's not just fundamental analysis on stocks, but it's my opinion, my real, fully transparent opinion on here's what I'm doing, here's what's going on with my businesses, here's what I'm seeing, and it's this idea formulating that we get to do together. Generally, every day the market is open. Sometimes I make a mistake and I miss, but usually I'm there every day the market is open. So what does this practically mean? So practical guide to this. Well, short term, this kicks the recession down the road. What to watch for? Credit loosening. I know everybody's talking about credit tightening, But remember, the time to start thinking about what other people are not paying attention to is now. So what does that potentially mean? Maybe finance companies are becoming the place to be. In other words, banks, credit cards, PayPal just launched their stable coin, right? These are all examples of places to consider being when you're on the upswing. In credit expansion, you want to be in these companies. Hashtag not financial advice. I am a licensed financial advisor, but obviously I don't understand your portfolio. Maybe one day in the future I can actually give you personalized financial advice, but that would be down the road. So maybe not too far down the road though. So short term, this kicks the recession can down the road. We look for credit loosening. Maybe finance companies start becoming a place we really want to fundamentally look for opportunities. Because in credit expansion, you want to be in these companies. Then the risk that you want to watch for is credit payments as a percentage of disposable income. Watch this approach and exceed, in my opinion, 2008 levels. I'll probably say 2007 is more accurate. 2007 was the peak. Okay. And then eventual risk, real great reset, so to speak, bubble, explosion, crash. But before that, I would actually expect an earnings trough potentially in Q2, Q3 of 2023, and credit expansion supports new growth at companies. So short term, this is actually good. Longer term, this is going to sow the seeds today of the next financial crisis. My take, make sure to check out the programs on Building Your Wealth link down below. You can also shadow me when we explore real estate. Check that all out via the link down below. Get lifetime access to those course member live streams, all the other access to beautiful courses on building your wealth through real estate, stocks, entrepreneurship, being an employee, you name it, there's a program for you. You can even bundle them together or email us at staff@meetkevin.com if you have any questions. Thanks so much. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.